Alright, let's talk about liquidity and volatility and their relationship. So more liquidity usually means more price stability.
My man!
But when liquidity, or money, is absent in a market, price volatility increases. Which can mean large players or news catalysts have a larger impact on price. And it also usually means that riskier assets have fewer buyers. And this chart right here summarizes it pretty well. So when you have thin liquidity or an illiquid market, you'll have wider spreads, slower fills because there's less buyers and sellers in that market to fill those orders, and that in turn can lead to higher volatility. But with thick liquidity or more liquid markets, you'll have tighter spreads, faster fills, and in general, lower volatility. So liquidity is just a reference to how many buyers and sellers are in any given market. The more liquid a market is, the more money can go in and out any given time without moving the price much at all.
Nice.
This is extremely important because a lack of buy and sell orders can cause a market to fluctuate much more rapidly than usual. Without all the extra orders from the abundance of buyers and sellers, there's less money coming in and out to absorb market fluctuations.
Totally.
For this reason, it's more common to see large price swings in bear markets as investors withdraw their money and liquidity declines. But just keep in mind that bear markets, though generally the periods of the most prolonged and aggressive declines in liquidity, are far from the only times that liquidity matters.
Say what?
Both seasonality and time of day are consistent factors contributing to overall liquidity. As an example, holiday times of the year, like late December or anytime there is a 4-day weekend, usually come with much lower market liquidity, and as a consequence, the potential for more volatility.
Oh, hell no!
And at the most micro level, the market open and close are by far the most liquid times of the day. It's also important to keep in mind the liquidity of the specific asset you are trading. A market like the US bond market can handle billions of dollars being bought or sold without moving the market at all. But a penny stock might only take a few $100,000 to significantly push price one way or the other.
For real, you fuck with that?
If you're a small investor, liquidity probably won't be much of a concern in terms of getting orders filled, perhaps even with penny stocks. But the volatility will certainly affect you the same as anyone else in the market. So regardless of what kind of investor you are or how much you're investing, you should always be aware of the liquidity characteristics of the market you're investing in, including the longer-term macro liquidity cycle. Alright, that does it for this 101. But as always, stay happy, humble, and most importantly, solvent.